Hello, NuView family. We're back with another Wednesday webinar. It is me, Bill Corbett, coming to you live and in color. So today we're going to be talking about the attraction of multifamily investing, and we have Rosch Wadera, who will be giving us some great information. Disclaimer for today, NuView does not endorse any sales. We do not give any financial or legal advice. This is a purely educational platform that we provide for you guys to get more knowledge about the industry and different type of investments that you can participate in. First, what is a self-directed IRA? Well, an IRA is an individual retirement account, and the self-directed part is more of a marketing term, letting you know that you do have the power in your hands to make investments outside of the stock market, outside of those stock bonds and mutual funds. The main benefits of having a self-directed IRA, one is going to be diversification. There are plenty of people who only have their money in the stock market, and they're missing out on the plenty of other avenues where they can be getting additional income. Additionally, we do have tax savings. These vehicles are tax sheltered, so that means that you can either completely eliminate tax or save your taxes for another time. And finally, you can invest in what you know best. A lot of people have industry knowledge, being that we're talking about real estate today. You might have a leg up on the industry if you are invested in real estate already, or if you work in the industry. So you can use that knowledge and turn it into some dollars if you are diligent with your investments. Here at NuView, we do have 7 different type of plans. We have our personal plans, our Roth and traditional, our employer plans, which are available to anybody with self-earned income, our solo QRP, SEP, and simple IRAs. And some plans are meant for tomorrow, while other plans are meant for today. Our specialty plans provide a platform for you to invest while saving and getting some tax deductions. A couple different options here at NuView. We do have a lot of different ways that you can invest in alternative assets, but one is private entities, being limited partnerships, joint ventures, LLCs, trust. We have real estate, foreclosures, tax liens, apartments, the list goes on. Cryptocurrency, Bitcoin, Litecoin, Bitcoin, Lite, and Ethereum. Promissory notes, both unsecured, secured, performing notes, non-performing notes, the list goes on. The IRS does not tell us what we can invest in, they just tell us what we can't invest in. That's life insurance contracts and collectibles. Outside of that, if you can put title to it, 9 times out of 10, you can invest in it. We can't say if it's a good or bad investment, but we do provide a platform for you to invest in things that interest you. And now introducing our speaker, Rosch Wadera. He is the Director of Investor Relations for Upside Avenue. Without further ado, the man of the hour.
Hey, thanks, Bill. I suppose I'll start with just a little bit of background, as far as where I'm coming from and what I do with Upside Avenue. So first off, Upside Avenue, what is it? It's a real estate investment trust, but we're not traded on a national stock exchange like the NYSE. So in other words, we're privately held, and we're based in Texas. So I'm coming to you guys live from Houston, Texas, but our headquarters are actually in Austin. So Director of Investor Relations, that means that I'm the lucky guy that gets to talk to all of our investors, as well as any prospective investors that just want to learn more about Upside Avenue, chat with me and hear about our portfolio, what's going on, how we've been performing. I get to be that lucky person that gets to have that conversation and meet and talk to hundreds of folks all across the country. But before Upside Avenue, I was a real estate developer. So I put up 5 commercial buildings across the state of Texas. And before that, I was an investment banker in Houston. So of course, I focused on oil and gas, completed half a dozen investment banking transactions with publicly traded and privately held oil field service companies. So my forte is accounting and finance, but real estate is that vehicle through which I get to apply my skill sets and, more importantly, generate wealth for myself and all of our shareholders through Upside Avenue. So I suppose, Bill, I should go ahead and share my screen now, and we jump right into the presentation. Again, Upside Avenue. Today we're going to talk about real estate, and I've just got to reiterate, a couple disclaimers that Bill had already touched on, but I just want to reiterate. Number one is no securities are being offered for sale during this presentation. This is purely for informational and educational purposes. And number two, even though we're doing a website with Entrust, that doesn't mean that Entrust is by any means endorsing us as an investment. In fact, what I love about the self-directed IRA is that each person becomes their own fund manager, your own capital allocator. And so it's up to each person to do their own due diligence. So again, this is just for informational and educational purposes within the real estate investment community. So let's see here. Yep, got the disclosure out the way. So real estate investing, REITs or direct purchasing. I'm sure most of the folks that are listening to this already know what a real estate investment trust is and what we mean by direct purchasing. So generally, two ways that we can get involved in real estate. Number one is we can purchase shares of a REIT, public or private. Or number two is we can make direct investments ourselves. And within that, I would further classify, you can go and buy a property yourself. You might want to syndicate capital in order to go and purchase that property, or you can invest in a fund. So there's a lot of different ways to look at all of it, and sometimes it can feel a little bit overwhelming. So I'm just going to share kind of pros and cons of each, or things rather I would look to evaluate one versus the other, so we can help and help folks make better decisions in allocating their own capital. So very quickly, we're going to start with why real estate, but I feel like if you don't know, you are amongst the very small minority of people who don't already know the wealth creation potential of real estate. In fact, if you look at most of the wealthy folks, it has been through real estate, or rather, they take the wealth that they've created through those other businesses and then invest it in real estate because it's a great store of capital that preserves your capital. Of course, there's risk in every investment, but relative to other asset classes, one might say real estate is on the lower end of the risk spectrum. So not only does it differentiate itself in terms of the risk, it provides you with that appreciation potential that's inherent in real estate, where it has its own inherent moat, a fixed piece of land or property in an area where the population continues to grow, generally will go up in value. And then at the same time, you also have income potential from real estate. Now, unlike the stock market, it's not as actively traded, so it's not as volatile, meaning someone with retirement funds to invest in the stock market, you can see we're hitting some lows over the last week, and it seems that it'll continue to keep dropping. Whereas our real estate investment trust, for example, our share price has not changed one bit in the last few weeks. So that's what we mean by non-correlated with the stock market and less volatile. Best of all, it's a tangible asset. It's nice to invest in things that you understand, that you can touch, and that you know the service and the value that they provide to society. So pros and cons, and there are some cons, so let's start with that. If we were to purchase real estate directly, we would have the benefit of being able to claim depreciation to the IRS. And many times, this depreciation will be greater than the income that piece of real estate produced. So you would actually show a loss. Even though you made money, you could show a loss. Consult your tax professional. I am not a licensed CPA, but this is a general thing that's known within the community. And with that loss, it does provide some tax advantages. Whereas with the REIT, that tax, it's not passed through. So, and more importantly, with the REIT, we actually don't have to pay corporate income taxes so long as we pay out 90% of our income to our shareholders in order to maintain that REIT qualification. So it's basically the IRS giving us a tax break with the caveat that we pay out all of our earnings. And so this makes it an income producing vehicle. Generally, it's supposed to be, at least, while at the same time getting the benefit of that appreciation in your original principal investment that comes along with the rise in the value of the real estate that the REIT owns. And if you think about, dividends, I think REITs generally tend to be on the higher performing end of their dividend payment ability. Very rarely would you see a tech company, for example, pay out higher dividends than a REIT, just by nature of the business models. It's also generally an inflation protected asset. So we're in a time where we are experiencing hyperinflation. And I'd strongly encourage all investors to keep that in mind as you invest going forward. Are you investing in something that is protected from inflation? Debt, for example, notes, for example, may attract you because of a high yield, but the principal balance, even if you get back the same amount you invested, technically, after the cost of inflation, you got back less. Whereas with real estate, just think of the housing prices and how they have skyrocketed. And we tend to think that, oh, the housing market is going crazy, but much of that is just the repricing of our real estate assets to keep up with the devaluation of the dollar. All right, so let's compare these direct deals and REITs. So first, on a cash flow basis, and I like these slides because they give a big overview, but I also kind of don't like these slides where they compare one industry over the other, or one direct deals in general over REITs in general. Even though that's what I'm presenting on, let me explain myself. I always say it's hard to say that one asset class is just always entirely better than the other. It really depends on that specific deal. So point is, we're speaking here generally on the differences, but that doesn't mean that a REIT is always going to be better than a direct deal or vice versa. It always depends on that specific deal that you're evaluating, which I'm sure most of the people would agree with and already knew. But from a cash flow standpoint, both give you cash flow, or they should, or they're structured to be able to do so. And both give you the long-term appreciation potential, whether you're investing on a direct deal basis or investing into a few shares of a REIT that has its own portfolio of real estate. Where we can see some significant differences tend to arise would be in regards to the day-to-day management. So here I have a personal side note that I'll share with y'all that I've learned from my own experience that might help others avoid that same mistake. So direct deals, especially if you're the one that's managing it, obviously, there's the cost of your time that now comes into play. REIT, if you are a shareholder of a REIT, it's entirely passive. You shouldn't have to do anything other than collect your dividend checks and then report the amounts to the IRS. So about as passive as you can get. So that personal side note that I wanted to share with you guys on this, that I learned the hard way, is, me personally, if you look at my background, I was a developer in real estate, put up 5 buildings across Texas. So I always thought to myself, hey, I can do this myself. I don't want to invest with anyone else. I want to do it myself because, I hate to admit it, I like the control. And I think that, okay, to make more money, I have to work harder and put in more time and effort. Now that I'm purely on the investment side, I've learned that investing, ironically, funnily, if that's even a word, is actually the opposite. You don't necessarily have to work harder to make more money. Your money is supposed to be working for you, and you can outsource these tasks. I'm also a licensed agent. I bring that up because I manage a portfolio of single-family homes here in Houston, and I manage it myself. This is what I was referring to earlier. And I look at the rate of return that I'm getting versus the rate of return that I'm getting from my passive holdings, my REITs, for example. And the difference between the two is not that much. But with my personal holdings, my direct investments, I'm putting a lot more of my time. So then I started to realize, if I actually factored in the cost of my time on this investment, then which one would come out higher or the other? So just something to keep out in mind for my fellow investors. Exiting your investment. So definitely with the direct deal, you can't just get in and out of it whenever you like. It depends on the other investors you're with. It depends on the project schedule. Whereas with the REIT, individual investors can come in and out of the REIT because the REIT is managing, so many shareholders and their portfolio of investments on their behalf. So assets may come in and out of the portfolio, while at the same time shareholders can come in and out of that portfolio. So essentially, that economies of scales, and with each shareholder making a small bit of the overall capital base, allows for more liquidity. But even within the REITs, the liquidity can vary. For example, with public REITs, you can come in and out at will. As long as the stock market is open, you can exit your position. Private REITs, however, like Upside Avenue, for example, we don't allow investors to exit their position within the first year. We ask that you be invested within a year. And then even then, we only redeem shareholders or allow new shareholders to come in once every quarter. And so, there's differences in terms of liquidity, but I would say, at least in real estate, unless you're doing a quick flip or a development project, I think you get the most out of it when you invest with a long-term orientation. Then there's the risk profile. And, I kind of disagree with my own slide here just a little bit, but it says here a higher risk typically in single assets. Yes, that's true. Absolutely. So for example, if I have 50,000 and I invest in a REIT versus 50,000 that I put in a direct deal, that 50,000 in the direct deal is going in one asset. For example, I'm investing in a multifamily development project over in Austin, Texas, by the brand new Tesla factory that they've just constructed. So $50,000 in one asset. Now, had I put that $50,000 in a REIT, you may think, oh, but it's the same, 50 grand in each case, one asset in each case. But within the REIT, underlying it, there may be 8 or 10 properties. For example, with Upside Avenue, again, no securities are being for sale. This is purely for educational purposes. But with Upside Avenue, the portfolio consists of 8 or so income producing properties, multifamily specifically, and then also a development project. So you get more of balancing your risk when you're investing into a portfolio like a REIT rather than directly investing in one deal. And then lastly is the investor qualification. So do you have to be accredited or not? And this to me is funny. I think the SEC originally came out with the accredited designation and requirements to protect shareholders. But I feel like nowadays, people are a lot smarter. Where more information is more readily available for us to educate our own selves. So sometimes it feels like being required to be an accredited investor to invest in those lucrative asset classes like private equity is actually kind of a little bit, it feels unfair. But there are a lot of REITs now, for example, Upside Avenue, where because of the Jobs Act under a Regulation A offering, both accredited and unaccredited investors could invest in these private assets. And I do think this is a trend that's going to only grow over time, where more of private equity is being open to non-accredited investors with lower minimums, where the usual 25, 50,000 is no longer the case. It can go as low as, for example, with Upside Avenue, just $2,000 to invest in our REIT, and a number of other Regulation A offerings out there as well. So real estate types. So we have on here office, industrial, retail, multifamily. So what I'll do just very quickly for the novice, but also for those professionals out there that already know the differences between the two, I just want to share kind of how I think about them differently, so we can just share this knowledge and within the investment community. So office, we all know what office space is. I think over here, the biggest thing we're all facing is, like, for example, I'm not in my office right now. So we all know that because of an effect that was created by the pandemic, is now the work from home culture has grown exponentially. It has taken off. And even those that are going into the office, more likely than not, they're doing it on a hybrid basis. So very few people are going into the office every day like they were before the pandemic. So what does this mean for the office asset class going forward? That's up to the investor to judge the risk-reward ratio for themselves. Then there's industrial. I don't think industrial was affected the same way by the pandemic as office space was. If anything, I hear that it's booming, that there's an industrial boom to build out warehouses and things of that nature. But here's one way that I would think about it differently from the others from an investor's mindset is the number of tenants you have. Generally, industrial warehouses are going to have 1 or 2 tenants. I mean, you could have a massive warehouse complex, and it's very common that it just be occupied by one large distributor. So what does that mean for us as investors when the real estate that I'm investing in has one tenant versus retail, for example, can have 100 tenants in one mall? In my opinion, I think there's more risk that I would have to account for when the real estate that I'm investing in has only one tenant, because there's always that risk that that tenant may go bankrupt, may go out of business, or might decide that, hey, you know what, I want to move to a different location. In that case, with industrial, that risk is much greater as opposed to, say, multifamily. If one of your tenants stops paying or two of your tenants decide to move out, you have 300 other tenants in that same property. On that same note, I also think about the length of the leases. So in office and industrial, you have leases that you sign ahead of time, and they can generally be over 5 years. Whereas multifamily, for example, those leases are usually 1, maybe 2 years. So what does that mean for us as investors? For me personally, going back to where are we right now in the broader economy, a hyperinflationary environment. So if I sign a lease with someone, guaranteeing a fixed price 5 years out, in year 4, in year 5, market rates could be way up there, and I'm still getting the same lease rate from 4 years ago. And we're all experiencing this. Everything's getting repriced higher and higher. So multifamily, for example, you have that opportunity to reprice each individual unit on a 12-month basis. So which of the two asset classes protect you from inflation, can keep up with the devaluation of the dollar? Then retail, can't reminisce. And this is a tough one. I've seen in my local town where my parents live, where I grew up, good old Sugar Land, Texas, the mall has gone out of business. At the same time, I've seen a mall inside Houston, the Galleria, one of the largest malls, and there is no slowdown over there. So it's tough to say without evaluating that specific property, but definitely the e-commerce has really put a huge pain point on the whole retail real estate industry. And but there's other ways that it could play out. I'm seeing a lot more tenants coming and occupying these consumer goods businesses that went out of business or that have gone totally online, now are being refilled in by these escape rooms or more eateries or things like that. And then lastly, we have multifamily. So bias, obviously, I work for a multifamily real estate investment trust. So naturally, folks can guess which one I'm going to favor. So I disclose that bias out in the open. But I love multifamily for the reasons I just mentioned: the ability to continue repricing to keep up with inflation. Having 200 to 300 tenants under one roof means I'm not so exposed to the risk of any one tenant losing his or her job, God forbid, but it happens. And then at the same time, I also just like to think about, well, what value do you add to society? So for example, with retail, say we hit a recession, say, unemployment skyrockets. Again, God forbid, wouldn't wish, that on anyone. Would like to see economic prosperity for everybody. But if it happens, are we going to stop going to the mall first? Or are we going to stop paying our rent first? We're going to stop going to the mall first. So thinking about it in terms of what provides a more direct need to society. In other words, if you lost half of your income today, which bills are you still going to pay? Which bills are you going to stop paying? So I've harped up on that quite a bit. Now we'll talk about, let's see what we have here. Different real estate types. I just think it's touching on different factors. Do you want to buy a property that has just one unit, but you own it outright? You don't have any other investors. Some people tend to prefer having that control. I used to be that way, but then I wisened up a little bit, but that's my personal opinion. But if you only want to invest in those things which you have 100% ownership, naturally you're going to be owning a bigger piece of a smaller pie, which might mean you might have less tenants, which might mean if that tenant decides to bail on rent and skip town, you're exposed to this risk. Whereas you invest in a smaller piece, but of a much larger pie, like a REIT, for example, if any one thing happens at one property, you have all these other properties to where the damage in one area doesn't impact you as bad as it would if that was the only piece of property that you own. So in other words, I'm just over explaining the basic concept of diversification, which we all know, which fortunately by REITs makes it easier for us to still own real estate, but get access to that diversification that it provides. And lastly is the economies of scale. So if you are investing in a fund that purchased single family properties, for example, versus my friend Bill over here is just going to buy that one single family property himself because he's a licensed agent. He wants to do it on his own. Go for it. Now, there's the economies of scale. So the cost to manage that one single family property that Bill got might be 8 to 12% typically the property management cost, at least from what I've seen in Texas. Whereas the property management fees that a fund which manages 1,000 homes might be much lower on a percentage basis because it's able to negotiate these economies of scales with its vendors, because it's able to have in-house property management. For example, Upside Avenue is owned by or managed by the Casoro Group. We have an in-house property management team. We have an in-house construction management team. So on my personal portfolio of single family investments, I have to outsource the maintenance. I have to hire contractors, and I'm paying retail rates. Whereas this professionally managed fund is basically insourcing the work because it's at that size it can do so, and therefore get some cost savings that we refer to as economies of scale. So now we're just going to talk about the multifamily industry in general, some growth projections, some fancy cool graphs to make it look nice. So 350,000 units needed by 2030. I suspect it's more, but I'm not going to argue with those that are actually doing the research and making the projections. So is this an industry that we see growing, or is it an industry that we see declining? So basically, would you rather, in other words, just look around wherever you live. Are they building new things? Are more and more people coming into your communities, and is there more demand for this asset class? This is interesting. This is, I think, a generational shift. People are renting for longer, as opposed to earlier, the rush was, let me go and buy a home. So I'll use my own self as an example. I rent. I manage a portfolio of single family homes. I have a real estate portfolio. I own single family homes that I rent out to other people, but I myself, I rent. And I think it's just a trend that's going across the younger generations, which I like to include myself in, even though I look a little older. But my point is why, and I think it's just population preferences. So number one is people prefer mobility more now than they did before because we don't have to be fixed into one location. Not all of us, but many of us have the ability to work remotely. So I don't want to buy a house knowing that I might move to Austin next year. I might move to New York City the year after that because I can work remotely. So renting now seems more of an attractive option. And there's a lot of convenience that comes along with renting. You don't have to pay property taxes. You're not responsible for maintenance yourself. And you have these very nice amenities. For example, we're developing an apartment complex in San Antonio that comes included with high-speed internet, USB outlets in the kitchen, and even the older complexes that we own, we're upgrading them, constantly putting them new appliances in there. And little things like having to change a light bulb, you can just call maintenance to come and do it for you. And best of all, there's a pool, there's an amenity center, there's a gym. That's all included within the cost of renting. Whereas if you bought your own house or lived in your own home, you would have to pay way more to get a pool installed, and then you don't have to drive all the way to the gym. But to each their own. Point of this slide is just that renting is becoming a more and more attractive option, not just because it's economical, but because it generally might provide a better lifestyle in some cases. Of course, there's always exceptions to the rule, and it's tough to talk in generalities. But moving on, so kind of just harping on that older slide. The numbers are going up in terms of people are renting for longer. as I mentioned previously. But what's really interesting also over here is you're seeing that 60 and over. So folks, the senior citizens, it is becoming more common and more attractive for them to rent. In fact, I can say, in Austin, there's been a lot of development for these 55 and up communities. So rental communities that are exclusively focused on those that are 55 and older, something that's different from kind of the prior decades. And here we just touch on migration reports. So this is just, as we always say in real estate, location, location, location. I think that holds true in every aspect of real estate, whether it be on the sales side, whether you're a realtor, whether you're looking to buy a house, or whether you're an investor actively managing your own portfolio, or on a passive basis, investing with another operator. Is ask yourself, where do they own assets? And in those cities, what's the population growth? So Texas, for example, because that's where I am, that's where Upside Avenue is located. I'll use it as an example because I know those stats off the back of my hand. San Antonio, Dallas, Houston, the three cities where most of our portfolio is concentrated, all have positive population growth, all have positive wage growth. I think is an important one to watch when you're evaluating any other real estate operator. Is the cities that they're investing in, do you have more folks moving into that population? And on top of that, more importantly, is their average wage growth. Is it going up? Are their wages going up? Because you can't hike up rents if the folks that live in it aren't also making more money. More importantly, if they're not seeing their incomes rise, they're not going to be as willing to pay for an upgraded property. So here we have some stats on those cities where folks are flocking to. And I think we're at one of our last slides. This is just something we wanted to do, especially for the NuView Trust community. I'm just trying to move my thing. There we go. So what we did here is, because another question we get a lot is public REITs versus private REITs. And I always start with, well, it depends on the specific assets that REIT owns. And it depends, more importantly, on the price to buy into that portfolio. So you could have a phenomenal asset, high demand, well located, but once they start, going over a certain price point, doesn't necessarily mean it's going to be a good investment anymore. So it's not just what you own, but the price you pay for it. However, the point of this slide is just showing us, basically, we took all of the publicly traded REITs in the residential space. So publicly traded specifically because their information is readily available and publicly disclosed. Although I do want to caveat, even if you're a privately held REIT, like Upside Avenue, for example, our information is also readily available. We have audited statements that we have to submit to the SEC, which are available on the SEC's website itself. So even in the private space, you can still get that financial transparency that I think makes for a better investment. But my point here is, we looked at the dividends per share for each of these REITs. So you see I've identified most of them are multifamily, but we also have some publicly traded single family REITs. And there was even student housing and manufacturing homes over there. And we looked at the rate at which their dividends were increasing. So for me as a value investor, I love growth. We get growth in real estate as the land values go up, as the rents grow up, but always tie my investment down to what's the income potential of that asset. And more importantly, is the income that asset produces, is it going up? So with the case of public REITs, one way we can gauge that is the dividends that it pays out per share. Is it going up? So you see here, point of this slide is saying that the median growth rate on the dividends per share. So if I'm getting $1 per share in dividends, for example, if it is growing at, on a year-over-year basis, 3.5% or more, it's at the top half of the dividend growth rate for REITs. So that's a number I would remember for anyone interested in investing in REITs. You're going to get a lot of really good marketing materials from all kinds of folks out there, and I'm sure they're genuine. But as investors, we want to tie everything down to the numbers. And so we need numbers to compare one over the other. The one that I like that I'm sharing with the folks that are watching is that 3.5% is the median rate at which dividends per share grow across the publicly traded residential REIT space. So since we're talking about private versus public REITs, just a graph over here that's showing the historical yields generally tend to be higher than in private REITs than they are in public REITs. So why are private REITs outperforming public REITs? I don't know the exact answer, but my theory is just because in the private markets, there is less competition. Although I'll be honest, in the assets that we're acquiring, we have a lot of bidders and we go up against a lot of bidders when we're buying these apartment complexes. So there's still competition, make no mistake. But unlike the public space where you have thousands of investors and hundreds of hedge funds constantly evaluating stock prices, looking for a good deal because they're always for sale. In the private markets, you have billions, if not trillions worth of real estate all across America, but only a certain percentage of that real estate is available for sale. So, I think this is one of the reasons why the private REITs, not only that, but I think to acquire interest in private REITs, you have to go through a broker or you have to do your own sourcing. You need to go through the contract. So the point is to buy into the investment, there's a much bigger hurdle, which might be a reason why they generally tend to outperform public REITs because their prices may not be as high because they're not as actively traded, which is why those investment sponsors or operators that make private investing in private assets available to folks on a passive basis where you don't have to do all the work but can still get those higher returns in that asset class, I feel can be especially attractive, especially if you add on to the fact that investing in it through your IRA, where you get those tax advantages, it could be a very lucrative thing to do, which I think is the reason why, NuView exists and we're having this webinar. But some questions to ask yourself, and then I think I'll be done after this is, what are your investment goals? So do you have a 2030 investment horizon from now until when you retire? If so, then does that mean that you should take on higher risk investments with the caveat that you're diversifying accordingly to manage the additional risk that comes along with that? Is liquidity a concern for you if you're planning to retire in the next 5 or so years? Then volatility could also be a concern, whereas I'm not too worried about the volatility in my portfolio because I don't plan to actually liquidate it for another 2 or 3 decades. And then how do you feel about risk? Risk in terms of how much of the investment return on this asset is derived from its future potential versus the cash flow that it's producing today. Do you want to be active in the day-to-day management? Look, if you need to be in control and manage everything yourself, go for it. But if you only end up making a 17% IRR, whereas there was a passive investment that was making a 14% IRR, one's lower than the other, but put into the cost of your time of managing everything else yourself. And could you have used that time elsewhere to make more money, in another means? What industry or asset class do you want to invest in? Some industries are by nature more risky than others. Tech companies, for example, are much riskier than others because it's betting on the future potential to add value to society and for customers to adopt that product. Whereas a single family or multifamily residential investment is not going to have the same risk profile as investing in VCs backed startups. Where is the investment? So again, if we're talking about real estate, we want to invest in areas where the population is growing. So at a minimum, land values should be going up. As opposed to areas of population decline. Beaumont, Texas, for example, when I was a developer, I was bidding on contracts to demolish homes. The city of Beaumont was willing to pay people to come and demolish hundreds of homes because people were just leaving the town and these homes weren't producing property taxes anymore. and they were a very bad eyesore and becoming kind of a problem for the city of Beaumont. So would you want to then build 100 homes in the city of Beaumont where there's not so much of a population growth? Of course not. What is the investment model? So I like to think of this in terms of, are we buying and holding for the cash flow? Then in that case, the cash flow that it produced historically is really what we're betting on, which sounds on the lower end of the risk spectrum. But there's other investment models out there. For example, at Upside Avenue, we don't necessarily buy assets for their existing cash flow. We buy assets and underwrite them based on, after we go and fix everything up, after we go and do all the maintenance work that the prior owner had deferred for X number of years, then what is its cash flow potential? A little bit riskier because we're betting on the future cash flow rather than the historical cash flow, but much higher rate of return. So that's what we mean by the investment model. And then what are the historical projected returns we touched on? So we do have a lot of informational materials that we'd love to share. But more importantly, if anyone wants to jump right into the portfolio that we manage and any financial details regarding that, we're a very transparent investment vehicle. So my email is there and you can reach out. And again, this is purely for informational and educational purposes. No securities are being offered for sale. So I'll turn it over to you, Bill.
Well, thank you, Rosch. I appreciate that detailed presentation. There was a lot of good information in there, and the good people do know where to find your information. And if anyone wants to reach out to us here at NuView and try to make some connections or anything, we'll be sure to try to pass that information along.
Awesome.
So if there are any questions or anything, please feel free to type them in your chat window or reach out to us, and we'll be happy to have a quick Q&A. But if not, we can definitely wrap some things up if you feel good about the presentation.
Yeah, sounds like maybe we'll give it a few seconds, see if there are any questions. But either way, my contact info is here on the slide. And anyone that's just interested to learn, even if it's you have any of your own investments that you want to compare against ours, I love running the numbers. And favorite part about working at Upside Avenue is we have hundreds of shareholders all across the country, and every person I talk to, I'll learn something new from their experiences and their personal investments and all the different walks of life.
Okay, well, thanks again, Rosch. We will be in contact. I do appreciate your time and your energy today. So, oh, wait, did something pop up? Sorry. Oh, could you please review type A properties?
Okay. I'll be honest, I don't fully understand the question, but I do appreciate someone asking the question. Please review type A properties. I think maybe Mr. Corwin is referring to Class A, Class B, Class C. So we do put the multifamily investments into different classes. At least at Upside Avenue, we mostly invest in Class B and Class C because they tend to have the most potential for renovation and therefore increasing their value, forcing that appreciation. We also are, like I said, developing a property. And if you're going to develop something brand new, you got to make Class A. There's no point in bringing something brand new online to the housing stock that is, not upgraded with the latest features. But I think probably the best way to differentiate it is the age, right? So anything built in the last 5 years or so, I would say is Class A. And then as you go older and older and older, it could be Class B, Class C. You can go all the way down to Class D. Naturally, the difference between these different classes is their income potential. So the rate of rent that you can charge. For a Class A, $2,000, $3,000 a month, not uncommon. For a Class C, $800 a month, $1,200 a month. Of course, depends on the location, this and that. And then the other way is by the amenities. So a Class A probably is going to have a gym included, a pool. Each unit is going to have a washer and dryer. Class C, maybe there's not a washer and dryer. So to wash your clothes, you'll have to go over to the local washateria. Less amenities, but you pay a smaller price. And then the appliances are not going to be the latest. You know, you might have an older fridge and things like that. And then lastly, I would differentiate them based on the property management. So in theory, if I'm at a Class C property, I should still get responsive property management. But at least with ours, it doesn't matter what property we own. We manage everything in-house. So we manage it to the best of our abilities and be, responsive. But I wouldn't be surprised if you actually looked at the maintenance response rate of Class A versus Class C. Class C probably would lag a little bit.
Well, that was very thorough. I do appreciate that response. We have another question here. It's, do you require a minimum dollar amount for investments?
Yeah, so that's the wonderful question. I'm so glad whoever asked that question. We do require a minimum, but only $2,000. That's it. And that's one of the reasons that I came to work for Upside Avenue. Every other real estate private equity fund that I've looked into is usually 50 grand to invest in. And even if you have 50 grand, a lot of people do. But my point is, do you really want to put all of that cash into just one asset? So because we're a Regulation A offering, you don't have to be an accredited investor to invest with us. The minimum amount is just 2,000. And lastly, we do ask though, no one should invest more than 10% of your net worth with us, or in general, in any one asset class, or in other words, more than 10% of your income. So I think if you make at least 20,000 a year, the 2,000 minimum would be appropriate in terms of you not putting all your eggs in one basket.
Yeah, that's a very low barrier to entry. So I do think it can be very advantageous for people that are looking to invest on the smaller side, or even just getting started. Starting somewhere is very important. That's the first step.
Yep. Our play is the power in the numbers. We're looking at servicing as many investors as we can, regardless of how much they have to contribute. We just want to, service as many investors as we can, and we believe that therefore we'll be able to service as many tenants as we can to provide the best communities with the best maintenance and amenities and things like that.
All right. If there are no more questions, Rosch, again, I do want to thank you for your time, and I hope to speak with you soon.
Yeah, check us out, upsideavenue.com. Thank you.
Thank you. Take it easy, man.